The backdrop to all of this is what's going on in China. But China's looking quite good, Karen, if you look at what's actually going on. China's up 8% year to date. You've had recent yuan strength. It's up 4% since June. And that's a reflection on the economic environment improving and also an economic rebound because they seem to have got their act sorted out. GDP growth in China is set for plus 2.1%. Remember that the US, Europe and Japan are all showing signs of contraction for the year. So that looks like the best economy. It seems to be doing well with all the economic uncertainty around the elections as well. Remember, China's policy is very focused on domestic consumption, and that's what we're seeing starting to play out.
But they've got a problem, don't they, Yogi? And good morning to you. It's Jeff. And the problem is President Trump and the continued onslaught that we get on the technical side here. So, you know, one of the news stories that we're covering today, obviously this latest focus on SMIC, the largest chip manufacturer and producer in China. This is very much at the heart of China's tech industry. Are you not concerned, and I note that you like China e-commerce, are you not concerned here that this just continues to give the market reasons to be lighter on China rather than heavier?
There are definitely risks. We've seen the whole fiasco around TikTok as well. But it's not just tech that's under pressure. You've obviously got the whole healthcare sector in China as well. It all comes down to a relative trade, China versus the US or China versus Europe or China versus Japan. And China just looks like it is in better shape despite what's actually going on between the geopolitical uncertainty around the elections and Trump attacking China. There are a whole range of things like iCloud computing that are doing really well. Healthcare is doing better. The financials are starting to do better. That's all on an improved outlook in an economy that just isn't contracting in the way the rest of the world is. So there are reasons to be concerned short to medium term. Once we get through the election, we think the policy will be firmer and more straightforward and more open and transparent. And that's good for Chinese equities. But we're talking about year end into Q1 next year.
For the sake of the argument, let me push back and just say, obviously, China looks to be doing better because they have supported the supply side of the economy. And when you look at the industrial profits, obviously up strongly here because they can get plant and machinery operating very quickly. But the exports are going to countries in the West that have maybe rather more indifferent prospects in terms of economic growth running into 2021. Isn't that the problem, that the people that China exports to may go through their own problems in the first half of next year, and that will have knock-on consequences?
Yeah, absolutely. You make a good point, Jeff, around what's going on with the export-led recovery in China, especially with the yuan up 4% since June. That's not going to help matters. However, China's policy is very focused on domestic consumption. The PBOC are continuing to provide lots of support into the financial system. That's all going to be the focus going forward. So stay focused on domestic consumption, domestic China, not export-led China, which will clearly be under a lot of pressure over the coming months. I don't know if you saw Jinping talk about being carbon neutral by 2060. Wow, what a change in sentiment we're actually seeing in China. News flow coming out of China is definitely more positive than negative relative to the rest of the world.